studying your last two. I swim med when they turned in. The styren down to mute. And can learn the pole that sunk he died.
When most people first learn tax preparation, they start with personal tax returns. In a personal tax return, the process is relatively simple. An individual receives tax slips such as a T5 slip, a T3 slip, or a dividend statement. Those slips are entered directly into the tax software, and the software calculates the tax return. The flow is straightforward. Tax slips, then tax software, then the T1 return. This is why personal tax reporting is often described as direct reporting. Corporate tax reporting works very differently. A corporation may receive the same T3 slips, T5 slips, dividend statements, and investment summaries, but those slips do not usually go directly into the T2 tax return. Instead, the information must first be recorded in the corporation's accounting records through journal entries. Those accounting records are then used to prepare the corporation's financial statements. Finally, the financial statements become the foundation for the T2 corporate tax return. So the corporate process follows a much longer path. Tax slips and investment documents, then accounting records, then financial statements, and finally the T2 return. This distinction is one of the most important concepts in corporate tax preparation. For personal tax, the return is primarily slip-driven. For corporate tax, the return is accounting-driven. If you remember only one thing from this slide, remember this. Personal tax starts with slips and ends with a tax return. Corporate tax starts with slips, but those slips must first flow through the accounting records and financial statements before they ever reach the T2 return. That accounting-first approach is the foundation for reporting investment income correctly in a corporation. One of the biggest reasons corporate tax reporting differs from personal tax reporting is the fiscal year-end mismatch problem. For an individual taxpayer, everything is simple. Personal tax returns always cover the calendar year, from January 1st to December 31st. T5 slips, T3 slips, and other tax slips are also prepared using that same calendar year. As a result, the reporting periods align perfectly. The tax preparer can generally enter the slips directly into the tax software with confidence that the income belongs to the correct tax year. Corporations are different. Unlike individuals, corporations can choose their own fiscal year-end. For example, a corporation might have a year-end of March 31st, May 31st, June 30th, or September 30th. Now imagine a corporation with a fiscal year running from June 1st, 2024 to May 31st, 2025. The corporation later receives a T5 slip covering January 1st, 2025 to December 31st, 2025. Notice the problem. The T5 slip covers a completely different reporting period than the corporation's taxation year. The dates do not match. If a tax preparer simply enters the entire T5 amount into the corporate return, several problems can occur. Some income may be reported twice. Some income may be missed entirely. And some income may end up being reported in the wrong taxation year. This can lead to inaccurate financial statements, incorrect tax calculations, and potential CRA reporting issues. That is why corporations cannot rely on tax slips alone. Instead, they rely on accounting records that track investment income based on the corporation's actual fiscal year. These accounting records ensure that income is reported in the correct period, regardless of when the tax slips are issued. The key lesson from this slide is simple. Personal tax reporting works because the tax slips and tax year match. Corporate tax reporting requires accounting records because the corporation's fiscal year often does not match the reporting period shown on the tax slips. That is why accounting records become the foundation of accurate corporate tax reporting. Now that we understand why corporations cannot rely solely on tax slips, let's look at the complete journey of investment income from the moment it is earned all the way to the final T2 corporate tax return. The process begins when the corporation earns investment income. This income may come from GICs, bonds, stocks, ETF, mutual funds, dividends, or interest-bearing investments. At this stage, the corporation has earned income, but nothing has yet been reported for tax purposes. The next step is to record the transaction in the accounting records. This is done through journal entries. For example, if the corporation earns interest income, the accountant records the transaction in the general ledger by debiting cash and crediting interest income. These journal entries become the foundation of the accounting records. Once all investment transactions have been recorded, the information flows into the corporation's financial statements. The income statement reports items such as interest income, dividend income, and capital gains. The balance sheet reports the corporation's investment assets, cash balances, and other financial information. These financial statements are then used to populate the T2 tax software. The information flows into Schedule 100, which contains the balance sheet information, and Schedule 125, which contains the income statement information. Additional schedules may also be completed depending on the nature of the investment income. Finally, after the financial information has been properly recorded and imported, the corporation's T2 tax return can be prepared. Notice the key principle illustrated on the right side of the slide. The wrong approach is to take a T5 slip and enter it directly into the T2 return. Doing so skips the accounting records and financial statements, increasing the risk of errors and incorrect reporting. The correct approach is to start with the tax slip or investment document. Record the information in the accounting records, prepare the financial statements, and then complete the T2 return. This is the accounting-driven process used in corporate tax preparation. If you remember one concept from this entire section, remember this: investment income does not flow directly into a corporate tax return. It must first flow through the accounting records and financial statements. In other words, the accounting records drive the T2 return, not the tax slips. That principle forms the foundation for properly reporting corporate investment income and understanding more advanced topics such as Schedule 3 reporting, aggregate investment income, ARTO calculations, and corporate tax planning.